Disclaimer.
Hey, my friends. Economics Exposed here. Listen closely. The paper market just hit a mathematical wall it cannot climb. While the masses are panic selling the $74 dip, the elite are chuckling because they know the game is rigged. Not against you, but in favor of a new commodity order. On February 3rd, the state of Wyoming, the #1 sound money state in America, officially dumped the banking system, moving their physical silver into a private in-state vault. Why? Because they know what's coming on March 1st. This wasn't a guess. Exactly 24 hours later, the White House dropped the hammer. Project Vault is now live, a $12 billion federal stockpile designed to drain the last remaining physical supply. And Vice President JD Vance just proposed the unthinkable, enforceable price floors. Next week, the exit door slams shut. The government is moving to make $70 to $80 silver the legal minimum, turning a volatile metal into a strategic asset. If you're holding paper contracts while Wyoming and the Fed are fighting over physical bars, you aren't just late, you're the liquidity they're eating for breakfast. We aren't looking at a chart, we are looking at the architecture of the Great Decoupling. I'm going to show you the internal policy documents that prove why March 1st is the day the math finally breaks the system. The window is closing. Let's look at the data. There's a date circled in red on every institutional trader's calendar right now, February 27th, 2026. That's 21 days from today. And on that date, the Chicago Mercantile Exchange faces what traders are quietly calling the event horizon. Here's what should grab your attention. Right now, as of February 6th, the COMEX March silver contract is sitting on 429 million ounces of open interest. That's the amount of silver that traders have contractually agreed to buy or sell. But here's where it gets interesting. The COMEX registered inventory, which is the actual physical silver available for delivery to settle these contracts, has collapsed to just 103 million ounces. Let me put that in perspective for you. We're looking at a 4-to-1 leverage ratio. For every ounce of actual metal sitting in COMEX vaults ready for delivery, there are 4 ounces worth of paper promises floating around the market. According to the CME Group's own data, this is the tightest inventory squeeze in the exchange's modern history. Think about this scenario. You go to your bank to withdraw your savings. You have $10,000 in your account. But when you arrive, the teller tells you they only have $2,500 in the vault. Oh, and by the way, 3 other people are in line ahead of you wanting to withdraw their money too. That's exactly what's happening in the silver market right now, except we're talking about billions of dollars in the entire global supply chain. Now, you might be thinking, haven't exchanges dealt with delivery squeezes before? Don't most traders just roll their contracts forward or settle in cash? That's what used to happen. But something fundamental changed in our economy over the past 18 months. The old playbook is dead. The artificial intelligence boom and the solar energy transition have created an unprecedented demand shock for physical silver. These aren't financial speculators who can be satisfied with cash settlements or paper gains. These are manufacturing companies that need actual metal to keep their production lines running. According to the Silver Institute's latest World Silver Survey, industrial demand for silver in 2025 jumped to 681 million ounces, a 17% increase from the previous year, driven almost entirely by AI server infrastructure and photovoltaic panel production. What if I told you that the industrial buyers aren't playing the paper game anymore? For decades, major consumers like solar panel manufacturers and electronics companies would buy COMEX futures contracts, then roll them forward month after month. Content to participate in the price discovery mechanism without taking physical delivery. It was efficient, it was predictable, it kept the market liquid. That system broke down when China implemented their new critical minerals export licensing system in January 2026. Suddenly, Western companies realized they couldn't rely on Chinese silver supplies flowing freely across borders anymore. The licenses can be approved or denied at Beijing's discretion, creating uncertainty that supply chain managers simply cannot tolerate. Have you noticed how quickly geopolitical tensions can disrupt your daily life? Remember the semiconductor shortage that made it impossible to buy a new car at reasonable prices? This is that same vulnerability, except it's happening with a metal that's absolutely critical to everything from your iPhone to the solar panels on your neighbor's roof to the data centers powering the AI revolution. So these industrial buyers made a strategic decision. Instead of rolling their March contracts forward and hoping the physical metal would be there when they eventually needed it, they're standing for delivery now. They're demanding the actual bars. They're moving 400-ounce ingots from COMEX vaults in New York directly to secure warehouses where they control access. The data doesn't lie. The March contract typically sees 10 to 15% of open interest standing for delivery in normal years, but Federal Reserve commodity surveillance reports from late January show that major industrial consumers have pre-positioned themselves to take physical delivery on an estimated 25 to 35% of the current March open interest. That's a behavioral shift that hasn't been priced into the market yet. Here's what this means for you personally. If you own silver ETFs, you're holding paper claims on metal that may not actually be available when the squeeze happens. If you own mining stocks, you're exposed to companies that might benefit from higher prices, but you're also taking on operational risk and management risk. The only way to truly be positioned for what's coming is to hold physical metal that you can touch, that's in your possession or in allocated storage where you have direct title. The February 27th first notice day is the moment of truth. That's when the exchange sends out official notices to all the long contract holders, essentially saying, okay, it's time to settle up. Do you want physical delivery or are you rolling your position forward? In a normal market, most traders get that notice and immediately roll forward or close their positions. The exchange breathes a sigh of relief, the inventory pressure releases, and the cycle continues. But this isn't a normal market anymore. Let me walk you through the mathematics of the trap that's been set. If even 25% of that 429 million ounce open interest stands for delivery, that's 107 million ounces that need to be physically delivered. Remember, the COMEX only has 103 million ounces of registered inventory available. The math doesn't work. It's physically impossible to deliver that much metal. And here's the kicker. According to the Commodity Futures Trading Commission's latest Commitments of Traders report, the commercial short position, which represents the banks and institutions that are legally obligated to deliver silver if called upon, is at near record levels. These institutions sold silver they didn't own, expecting prices to fall and planning to buy it back cheaper or settle in cash. But the industrial buyers aren't accepting cash settlements this time. They want the metal. You're probably wondering, what happens when an exchange can't deliver on its contracts? There are really only two options, and neither of them is pretty. Option one, the exchange declares a force majeure and imposes cash settlements at whatever the current spot price is, effectively defaulting on its obligation to deliver physical metal. This would shatter confidence in the entire COMEX system and likely trigger a massive repricing of physical silver, completely disconnected from the paper market. Option two, the price of silver explodes higher until enough holders of physical metal are willing to sell into the market to satisfy the delivery demands. This is the classic short squeeze scenario, where the people who sold silver they didn't own are forced to buy it at any price to cover their obligations. Both scenarios are devastating for anyone on the wrong side of the trade. The smart money saw this coming months ago. While retail investors were watching price swings, institutional traders were watching the inventory data. They knew the COMEX vaults were draining. They knew industrial demand was accelerating. They knew China's export licenses were coming. That recent crash wasn't random market volatility. According to analysis from Precious Metals, researchers at the Bank for International Settlements, that price collapse was triggered by coordinated liquidation of leveraged paper positions. But here's what matters. The physical market never followed the paper market down. The premiums on physical silver coins and bars barely budged during the crash. The disconnect between paper and physical was screaming a message that the real metal is scarce and the paper price is a lie. Think about what that means for your investment decisions right now. You have 21 days until the March delivery notices start flying. You have 21 days before we find out whether the COMEX can actually deliver the metal it's promised to deliver. You have 21 days before this 4-to-1 leverage ratio either unwinds peacefully or explodes into a supply crisis that sends shockwaves through the entire precious metals market. The event horizon isn't just a dramatic name. In physics, an event horizon is the point of no return around a black hole. Once you cross it, you can't escape the gravitational pull no matter what you do. The silver market is approaching its own point of no return. After February 27th, the forces that have been building will become irreversible, the delivery demands will be known, the inventory shortfall will be confirmed, and the market will have to reconcile the gap between paper promises and physical reality. What side of that event horizon do you want to be on? Now, let me show you the smoking gun that proves this isn't speculation. This is mathematical certainty backed by federal policy documents most investors will never see. The February 2026 contract just closed last week, and the delivery data that came out is absolutely unprecedented. According to the CME delivery report released on February 1st, 98% of the open interest in the February contract stood for physical delivery. Let me repeat that. 98%? You're probably thinking, okay, so what? Maybe that's normal for a smaller contract month. Here's why that number should terrify anyone holding paper silver. In a typical month over the past decade, between 8 and 15% of open interest results in actual physical delivery. The other, 85 to 92%, either rolls forward to the next contract month or settles in cash. That's how the paper system has functioned for decades. But 98% delivery? That's not a market. That's a run on the bank. The COMEX somehow managed to scrape together enough metal to satisfy those February deliveries, but it came at a devastating cost to the inventory. In the 2 weeks leading up to February 1st, according to CME Vault reports, the registered inventory dropped by 41 million ounces. That metal left the vaults and went directly into the hands of industrial consumers who are now storing it in private facilities where it will never return to the exchange. Have you ever wondered where that metal actually goes once it leaves the COMEX system? It's not sitting idle. Right now, as we speak, those bars are being moved to secure warehouses in Arizona, Texas, and Utah, where AI infrastructure companies are stockpiling the raw material they need for the next 3 to 5 years of server production. Once silver enters a corporate strategic reserve, it effectively leaves the tradable supply permanently. Think about what this means for the March contract. If February saw 98% delivery with much lower open interest, what happens when March's 429 million ounces starts demanding physical metal? The exchange has already been bled dry by February's unexpected delivery surge. Now here's where the federal government enters the picture in a way that should fundamentally change how you think about silver as an asset class. On February 4th, the White House officially launched Project Vault. The announcement was buried in a Department of Commerce press release about critical mineral security, but the implications are staggering. The United States government is now directly competing with private investors and industrial consumers for physical silver. The structure of Project Vault is fascinating and deeply troubling if you're on the wrong side of this trade. The program allocates $12 billion to acquire and store strategic reserves of critical minerals, with silver being the primary focus in Phase 1. But here's the key detail that most analysts missed. According to the Export-Import Bank of the United States quarterly report released on January 31st, $10 billion of that $12 billion is being financed through a special Exim bank loan facility created specifically for this purpose. Let me connect those dots for you. The federal government is borrowing $10 billion at favorable interest rates to buy physical silver at current market prices before the squeeze fully materializes. They're not buying paper contracts. They're not buying ETF shares. They're demanding deliverable bars from the COMEX and direct purchases from mining companies, effectively front-running the entire industrial supply chain. The timing is no coincidence. Project Vault launched exactly 24 hours after Wyoming became the first state to move its precious metals reserves out of the traditional banking system and into an in-state, privately managed vault facility. According to the Wyoming State Treasurer's Office disclosure from February 3rd, the state transferred approximately 4 million ounces of physical silver from COMEX allocated storage to a secure facility in Cheyenne. Why would Wyoming do this? Because state treasury officials have access to the same COMEX inventory data you and I are looking at right now, and they made a strategic decision that holding a paper claim on silver stored in a COMEX vault is riskier than taking physical possession and paying the storage costs themselves. When a sovereign state government makes that determination, you should pay attention. Wyoming isn't some fringe actor. They've positioned themselves as America's sound money capital, with laws explicitly recognizing gold and silver as legal tender and eliminating capital gains taxes on precious metals transactions. Their treasury team includes former commodities, traders who understand the difference between paper promises and physical reality. Now, you might be wondering, if the COMEX is running out of silver, can't they just pull from the eligible inventory? I've heard there are hundreds of millions of ounces sitting in eligible accounts. This is the myth that keeps retail investors complacent, while the smart money is taking physical delivery. Let me break down why the eligible inventory is not the safety net people think it is. As of February 5th, the COMEX reports a total silver inventories of 397 million ounces. That sounds like a lot, right? But here's the critical distinction. Only 103 million ounces are in registered status, meaning they're available for immediate delivery against futures contracts. The remaining 294 million ounces are classified as eligible. What does eligible actually mean? It means the silver meets the quality standards for delivery, but it's owned by specific entities who have chosen not to make it available for delivery. That metal belongs to exchange-traded funds like SLV and PSLV, to family offices, to high-net-worth individuals who are using COMEX vaults as secure storage. It is not the exchange's metal to deliver. For eligible silver to become registered and available for delivery, the owner has to voluntarily convert it by filing the appropriate paperwork with the exchange. And here's the brutal reality. At current prices between $74 and $80 per ounce, those owners are not converting. According to data from the World Gold Council's latest precious metals report released on January 28th, the average cost basis for institutional holders of physical silver stored in eligible accounts is approximately $62 per ounce. These are sophisticated investors who accumulated their positions over the past 3 years. They're not going to convert their metal to registered status and make it available for delivery at $78 when they watch silver trade at $115 just weeks ago. They know what you're learning right now. The paper market is broken, and physical silver is about to reprice dramatically higher once the COMEX delivery crisis becomes public knowledge. Let me give you another data point that confirms the global nature of this supply crisis. The London Bullion Market Association, which oversees the world's largest physical precious metals market, reported on January 23rd that total silver inventories held in LBMA-approved vaults have fallen to 738 million ounces. That's the lowest level since December 2010. Think about that timeline. We're back to inventory levels from 15 years ago, but industrial demand has more than doubled in that same period because of technologies that didn't even exist in 2010. We didn't have utility-scale solar farms covering hundreds of square miles. We didn't have AI data centers consuming millions of ounces of silver for server infrastructure. We didn't have electric vehicle production at current scale. The demand side of the equation has fundamentally transformed while the supply side has been gradually depleting for over a decade. And now, just as we're hitting that critical inflection point, the federal government launches a $12 billion buying program to drain what's left. You want to know what really keeps COMEX officials up at night? It's not the March contract in isolation, it's the cascade effect. If March forces cash settlements or triggers a short squeeze, every industrial consumer watching that scenario unfold will immediately stand for delivery on their May, July, and September contracts. The trust that has allowed the paper system to function will evaporate overnight. I want you to understand the mechanics of how that cascade would unfold, because it's unlike anything we've seen in modern commodity markets. When the COMEX declares force majeure and imposes cash settlements on contracts that specified physical delivery, that's not just a default. That's the exchange admitting that the paper price has become divorced from physical reality. At that moment, the spot price you see on financial websites becomes meaningless for anyone trying to acquire actual metal. The physical market will establish its own price based on what buyers are willing to pay and what holders are willing to accept. We've seen this dynamic play out in other commodity markets during supply crises. The premium of physical over paper can reach 30 to 50% in a matter of days. But here's what makes silver different from other commodities. According to the Silver Institute's industrial consumption data, approximately 60% of silver demand is inelastic in the short term. Solar panel manufacturers can't switch to a different conductor. AI server producers can't redesign their infrastructure to eliminate silver components. Medical device companies can't substitute alternative materials without years of testing and regulatory approval. These buyers have to pay whatever the market demands, and they have zero negotiating leverage when their production lines are at risk of shutting down for lack of raw materials. That's the dynamic that's driving the unprecedented delivery demands we're seeing right now. The Export-Import Bank's involvement in Project Vault is particularly revealing. The Exim Bank typically finances export transactions for American companies selling goods overseas. Their mandate is to support U.S. economic growth by facilitating international trade. So why are they providing $10 billion in financing for a domestic mineral stockpiling program? The answer is in the fine print of their January quarterly report. The loan facility was authorized under national security provisions that allow Exim Bank to finance activities critical to American strategic interests, even if they don't directly involve exports. The federal government is explicitly classifying silver acquisition as a national security priority. When you combine Project Vault's $12 billion buying power with industrial demand that already exceeds annual mining production by over 200 million ounces, according to Metals Focus's latest supply-demand analysis, you're looking at a mathematical impossibility. There is not enough above-ground inventory to satisfy all the competing claims. The March contract is where that impossibility becomes impossible to hide. The numbers are too large, the inventory is too depleted, the delivery demands are too insistent. Something has to break, and when it does, the repricing will be violent and unforgiving to anyone still holding paper promises instead of physical metal. Let me give you one more piece of evidence that this is all coordinating toward a specific outcome. On February 4th, the same day Project Vault launched, Vice President JD Vance delivered remarks at the National Mining Association conference in Phoenix. The official transcript, which you can find on the White House website, includes this exact quote. "We are exploring mechanisms to establish price stability for critical minerals that are essential to our national security, including the potential for enforceable price floors that would protect both American producers and consumers from artificial market manipulation." Price floors? Enforceable price floors for silver as a critical mineral. Think about what that means in practical terms. If the government establishes a price floor at, let's say, $80 per ounce, they're effectively declaring that silver cannot trade below that level regardless of paper market dynamics. Any institution holding short positions below that floor is going to face catastrophic losses when they're forced to cover at the government-mandated minimum price. This isn't speculation about what might happen. This is federal policy being implemented in real time while retail investors are distracted by price volatility and negative headlines about the recent sell-off. The architecture is being built right now to transform silver from a volatile commodity into a strategic asset with government price support. The window to position yourself ahead of this transformation is measured in days, not weeks or months. March 1st is the mathematical breaking point where the paper market's leverage ratio becomes physically impossible to maintain. February 27th is first notice day when delivery intentions must be declared. That's 21 days from today. Wyoming's Treasury officials saw this coming and moved their metal out of the system. The federal government saw this coming and launched a $12 billion buying program. The industrial consumers saw this coming and are demanding physical delivery at unprecedented rates. The only question that matters now is, did you see this coming and did you act in time? Let me show you exactly why March 1st is the date the mathematics finally overwhelm the system. This isn't a prediction, this is arithmetic. The COMEX March contract currently holds 429 million ounces in open interest. We just witnessed February's 98% delivery rate drain 41 million ounces from the registered inventory in 2 weeks. So let's be conservative. Let's assume March doesn't hit 98%. Let's assume the delivery rate drops to just 25%. 25% of 429 million ounces equals 107 million ounces that would stand for physical delivery. The COMEX has 103 million ounces of registered inventory available. 107 million demanded, 103 million available. The math doesn't work. It's a 4 million ounce shortfall at a conservative 25% delivery rate. But here's what should terrify anyone short this market. Based on the price action over the past 72 hours and the latest commitment of traders data released February 4th, the delivery rate for March is tracking closer to 40%. 40% of 429 million ounces is 172 million ounces against 103 million available. That's a 69 million ounce deficit. There's no scenario where the COMEX can physically satisfy that demand without either cash settlements or price spike violent enough to shake loose metal from private holders. Now, you might be thinking, can't they just get emergency deliveries from mining companies or pull metal from other global exchanges? According to the U.S. Geological Survey's Mineral Commodity Summary released January 15th, total U.S. silver mine production in 2025 was 33 million ounces. Mexico produced 190 million ounces. Those are annual numbers. We're talking about needing 69 million ounces in weeks. The metal doesn't exist in immediately available form. Importing from London? LBMA vault standards require 6 to 8 weeks minimum for armored transport, customs, and processing of 69 million ounces. March 1st is 23 days away. The logistics are impossible. The deficit is mathematical. The outcome is inevitable. So what actually happens on March 1st when the exchange can't deliver the metal it's contractually obligated to deliver? This is where federal policy and market mechanics collide in a way that will fundamentally reset silver pricing for the next decade. Let me connect the final dots. On February 4th, Vice President Vance didn't just float the idea of price floors as a theoretical concept. According to the National Mining Association conference transcript, he specifically stated that the administration is working with the Commodity Futures Trading Commission and the Department of Commerce to establish legally enforceable minimum prices for critical minerals designated as essential to national security. Silver is explicitly named as a Tier 1 critical mineral in the updated National Defense Stockpile Requirements published January 28th by the Defense Logistics Agency. That designation gives the executive branch authority to intervene in commodity markets under the Defense Production Act without requiring congressional approval. Here's what that means in practical terms. When the COMEX hits its mathematical breaking point on March 1st, the federal government isn't going to stand by and watch the exchange default. They can't allow that. A COMEX default would trigger a cascade of failures across the entire commodities complex. Every futures exchange in the world would face immediate credibility questions. The paper gold market would face the same scrutiny. Agricultural commodities would see delivery demands spike as traders lose faith in cash settlement mechanisms. The systemic risk is unacceptable to financial regulators. So instead, the administration will invoke their critical minerals authority and establish an emergency price floor. Based on the current policy discussions happening at the Department of Commerce, which were outlined in their Critical Mineral Strategy document released February 2nd, that floor is likely to be set between $80 and $85 per ounce. Think about what happens at that moment. Every institution holding short positions below $80 faces a government-mandated covering price. The managed money short position, according to the CFTC's February 4th report, stands at 83,000 contracts representing 415 million ounces of exposure. Those shorts expected silver to keep falling after the crash to $74. But if the government declares $80 as the legal minimum, the shorts must cover at 80 or higher. That's not organic market dynamics. That's forced liquidation mandated by federal policy to prevent banking system collapse. But here's where it gets even more interesting. The price floor isn't the ceiling. Once silver stabilizes at $80 to $85, industrial demand doesn't disappear. AI manufacturers, solar producers, and medical device companies still need silver. But now every buyer knows silver will never fall below $80 again. The government explicitly backstopped the price. That knowledge fundamentally changes purchasing behavior. Instead of waiting for dips, industrial procurement teams will immediately secure multi-year supply contracts because they have guaranteed downside protection with unlimited upside potential. According to Bloomberg intelligence analysis published January 31st, when commodities receive government price support, industrial forward buying typically surges 30 to 40% within 90 days. That surge in forward buying is going to hit a market that just burned through its entire available inventory trying to satisfy March delivery demands. The vacuum created by empty COMEX vaults, combined with government-mandated price floors, combined with panic buying from industrial consumers trying to lock in supply before prices spike further, creates the perfect setup for what traders call a moonshot move. Let me give you the technical setup that makes the snapback to $115 mathematically probable. Silver's January peak of $115.08 on January 18th crashed to $74 by January 24th. That's a 36% decline in 72 hours, but technical analysts at JP Morgan's commodities desk noted in their January 29th report that the volume during that decline was 3 times higher than the rally volume. That tells you the crash was forced liquidation of leveraged paper, not fundamental selling from physical holders. When prices correct due to forced liquidation, the recovery pattern is almost always a rapid V-shaped snapback. The fundamental drivers that pushed prices to $115 haven't changed. Industrial demand is accelerating. Project vault buying continues. Mining supply remains constrained. We're currently at $78, $37 below the peak. The March delivery crisis and government price floor will close that gap in weeks. Here's the specific scenario I expect to unfold. Between February 20th and February 27th, as first notice day approaches, we're going to see preliminary delivery intentions filed with the exchange. When those numbers get reported, probably around February 24th or 25th, the market will realize that the delivery rate is tracking well above 25%. That's when the first wave of short covering begins. Then on February 27th, first notice day, the official delivery numbers get locked in. If I'm right about 40% delivery rate, that's when the COMEX has to publicly acknowledge they cannot satisfy physical delivery demands. The exchange will announce emergency measures, likely a combination of extended settlement periods and appeals to eligible inventory holders to convert to registered status. But as we discussed earlier, eligible holders aren't converting at these prices. They know the endgame, so the exchange's attempts to source additional metal will fail. That's when the federal government steps in with the price floor announcement, probably within 48 hours of the COMEX admission. Once the $80 to $85 floor is announced, the scramble begins. Every industrial buyer, every family office, every sovereign wealth fund that has been watching this situation develop will simultaneously try to acquire physical silver before the supply is completely exhausted. That buying pressure, hitting a market with essentially zero available inventory, will drive prices through $90, through $100, and ultimately back toward that $115 peak, probably by mid-March. The snapback won't stop at $115. That was the peak during a market that still had functioning inventory. Once we're in a price floor regime with government intervention and acknowledged physical scarcity, the ceiling is determined by what industrial buyers will pay to secure supply chain continuity. Solar manufacturers, AI server companies facing multi-billion-dollar contracts, they'll pay whatever it takes. That dynamic sets up potential for silver to challenge $150 to $175 by late March or early April. Remember what happened to nickel on the London Metal Exchange in March 2022? It spiked from $25,000 to $100,000 per ton in 48 hours due to a short squeeze, forcing the LME to suspend trading. Silver is more strategic. The supply deficit is more severe. The government intervention is more explicit. Here's my final warning. The paper purge ends next week. If you're holding paper contracts, you're holding claims on metal that doesn't exist. When the COMEX declares force majeure, your contracts settle at distressed spot prices in the $70 to $75 range, while physical trades at $100 or higher. Silver ETFs face the same risk, disputed claims and years-long legal processes. The only position for what's coming is allocated physical silver in your direct possession or private vault storage with explicit title. Wyoming figured this out. The federal government figured this out. Industrial consumers and smart money figured this out when they bought the flash crash. The mathematical wall cannot be climbed. You cannot deliver 429 million ounces of claims with 103 million ounces of inventory. On March 1st, that impossibility becomes public. The great decoupling between paper and physical will be complete. The countdown clock is running. 23 days until March 1st, 21 days until first notice day. The exit door is closing. The question isn't whether you believe this will happen. The question is whether you'll act before the window slams shut. The architecture of the great decoupling is complete. The math has spoken. What happens next is inevitable.